So we got 3 levels, right? So we got the answer that when to order, right? When to order for a when to make a fresh order. Now the question comes that how much to order, right? How much we should order. So here there are many techniques. One of the popular technique is EOQ, right? So EOQ, economic order quantity, is one of the techniques of inventory control which minimizes total holding and ordering costs for the year. The economic order quantity is the technique which solves the problem of materials manager. Okay. Now, what is the definition of EOQ? EOQ is essentially an accounting formula that determines at which the combination of order, costs and inventory carrying cost are the least. The result is the most cost effective quality to order. In purchasing, this is known as order quantity. In manufacturing, it is known as the production lot size. So, EOQ is basically what it tells us, that when the company will order, right, what should be the quantity. So, what should be the ideal quantity at which it should be ordered. So, there are two models, right. One is called Q model, the other one is called the P model. We will discuss both, right. So, there are certain assumptions under EOQ models. What are the assumptions? First assumption is demand is known and is deterministic, that is constant. The lead time, that is the time between placement of the order and the receipt of the order, is known and constant. The receipt of inventory is instantaneous, and in other words, the inventory from an order arrives one batch at one point in time. Number 4, quantity discount is not possible. In other words, it does not make any difference how much we order and the price of the product will still be same. And the 5th one is the only cost pertinent to inventory model are the cost of placing an order and cost of holding or scoring inventory over time. So, when I am trying to decide that how much to order in a particular order, so I am making certain assumptions, because it is a model. So, I am making some assumptions. So, the assumption is that the whatever quantity you buy, there is no discount. This is a major assumption here, right. The lead time, we know that how much time, and it will not change, it should not vary, right. And and it is instant. The receipt of inventory is instantaneous, right. And there are 3 types of costs, which 2 types of cost which is been involved, that is holding cost and the ordering cost. So, that we will discuss now. Now, you see the first model which we will discuss, that is the Q model. Q model is, it says what? It says that when the company will order at a fixed quantity. The quantity will not change, that quantity we will decide, right. It can be 100, it can be 200 and 250, whatever. But once it is decided, in the same quantity the company will order today, after 1 month, after 2 months. So, the quantity will remain unchanged. In Q model, a fixed quantity of material is ordered whenever the stock on hand reaches the reorder point. The fixed quantity of material ordered each time is nothing but the economic order quantity. When a new consignment arrives, the total stock shall be within the maximum and the minimum limit. So, you see in the previous example, we calculated the minimum level of stock and the maximum level of stock. So, at any point of time, the inventory level should lie between this minimum level and the maximum level, but whatever the company will order, the quantity of order, right, number of units ordered, that will not change, that will remain same, right. That is the economic order quantity. So, graphically, if we look at graphically, it will be clearer. See, this is the this is time period, right, and company is ordering at different time periods, and this is the inventory level, right. So, you see what happens, once it reaches here, right, this is the minimum level, reorder level and maximum level, right. So, you see once it reaches the minimum level here, right. So, company places the order, right. Once it places the order, the EOQ, so what will happen, the inventory level will go up, right. So, maximum where it can reach here, right, maximum it can reach here. Now, once it reaches this maximum level, then the issuance starts, right, gradually the material starts going to the assembly line, right, or the production workshop, production department and all. When it will go, the inventory level will fall, right, it can fall. So, ideally it can be anywhere between this maximum level and the minimum level. So, at best it can reach this minimum level. Once it will reach the minimum level, again the fresh order will take place. What will be the quantity? Quantity will be the EOQ, right. The quantity of units ordered will remain same. So, once it is ordered, it will again move up to the inventory level will, the inventory level will move up, right. Again issue will happen, it will come down. So, this will continue for a period, continuously it will keep on happening, right. And this, you see, we keep a buffer stock between the minimum level and the reorder level, right. So, depending upon the level of production, the frequency of issuance, right, and the quantity of issuance, level of production, what we can do is, to keep ourselves safe, right, once it reaches the reorder level here, right, we can make an order, right, but we'll make an order, there is a lead time, right, it takes time. So, company can place the order once the inventory reaches here, right. So, there is a lead time, right. By the time from this buffer stock, the consumption will continue, but under no circumstances the stock level should go beyond this. It should not come down beyond this minimum stock level, fine, and like this it can continue for over the time. Okay. So, this is the the concept of the Q model. So, in Q model I am giving a recap. What happens, that once the stock reaches the reorder level, the order is being placed and there is a lead time between the date of ordering and date of receiving the actual stock, right. And once the order is being placed, the quantum of order will be of EOQ, right, and the consumption continues after placing the order and gradually it comes to the minimum stock level. By that time the new stock arrives. When the new stock arrives, the stock level again goes up and then again it gets consumed. So, like the process goes on over the time. Okay. So, what is the mathematical method? How to calculate the EOQ? The objective is to determine the quantity to order which minimize the total annual inventory management cost. So, it is to determine, what is the objective? Determine the quantity to order, right, which minimize the total annual inventory management cost. So, minimize total cost per period. So, objective is that we need to, how we will determine that what will be the EOQ? We will try to minimize the total cost per period, because this ordering and procuring, it involves cost. So, it is equal to inventory holding cost per period plus order cost per period, where the order cost equal to the number of orders placed in the period into order cost, and carrying cost is average inventory level into the carrying costs of the unit of stock for one period. So, these are the two costs. So, in EOQ, what we are trying to do, we are trying to minimize this cost. So, you see, if we discuss it like this, see, if the number of orders are more, then the ordering cost will go up, right? Because here you see it is number of order placed, here number of order placed into the, so if the number of orders goes up, then what will happen? The ordering cost will go out. Similarly, if the inventory level goes up, the carrying cost will go up, right? So, we need to optimize, we need to find out a solution for it. We need to find out that what is the quantity we should order, so that the combination of these two costs, ordering cost and the carrying cost, it remains minimum, right? And one thing you may notice here, that if your number of orders are less, then your inventory level will be high, right? I repeat again, if the number of orders are less, the inventory level will be high. So, if your ordering cost is on the lower side, the carrying cost will be high, and vice versa. The reverse is also true, right? So, we need to keep a balance between the two. So, we will see how it can be done. So, what is the formula? Formula is EOQ is equal to square root of 2 AP by S, where Q denotes the order quantity, the EOQ, and A denotes the demand per time period. So, we can take, say, annual demand, for example. S denotes the carrying or holding cost of one unit of stock for one period, and P denotes the order cost. So, what is the formula? Square root of 2 AP, EOQ is equal to square root of 2 AP divided by S. Holding cost, what are the examples of holding cost? As I said, that when you are carrying the holding the inventory, for example, so you incur several types of costs. Like, for example, you need a space, so there is a cost for space. If it is a rented warehouse, then you can say the rent, right? If it is on your own, then you invested money on it, so there is an opportunity cost, right? Then for the store, you need to take insurance, right? You need to deploy security personnel, so this involves cost. If you have purchased borrowed money for procuring this storage space, then you need to pay interest, right? That is a cost. If you are taking working capital loan, right, for procuring stocks, then also you need to pay. So, this, and if there is a excess stock which is not desirable at all, then the cost of obsolescence stock is also it is there, right. Ordering costs, what is ordering cost? So, when the order is been placed, it goes to certain process, like the store issues a requisition, then the purchase department floats a tender, then collects quotations, and based on the best quotation they issue the purchase order. So, this entire process, right, involves certain costs, like there are stationary costs, communication costs, transportation charges, right. If loading, unloading, so when it will come for loading, unloading, the cost for manpower cost. So, all these costs which we can attribute to ordering, right, which varies with the number of orders, we can consider that as ordering cost. So, now we will look at one example. So, as I said, the EOQ is what? EOQ tells us that how much to order, right, at a time, at one point of time. Now, what is the formula? Root over 2 AP by S. So, in this problem, the annual demand is 5,000 units, and the P, the ordering cost is 30, and the carrying cost, the holding cost is 6. What is holding cost? The cost company is incurring for holding the stock, right, holding the material in inventory. So, EOQ is equal to root over 2 into AP by S. So, I can write it like this. So, root over 2 into AP divided by S. So, is equal to root over, what is annual demand? The annual demand is 5,000. I will write 2 into, I can, okay. So, is equal to root over 2 into annual demand, that is 5,000 into P is 30, right, ordering cost, divided by the holding cost, that is 6. So, if I calculate this, so it comes to, if we solve this, you will find it is root over 50,000, right. So, root over 50,000, it comes to around 2 to 4 units. So, this one. So, now what is the meaning of this? The meaning is when the company will place the order should be in the lot of 224 units. If it does so, then what will happen? This ordering cost and carrying cost, it will be optimized, right. Okay. Now, what are the merits of this queue system? So, merits are the each material can be in the most economical quantity. Purchasing and inventory control personnel automatically devote attention to the items that are needed only when required, and positive control can be easily exerted to maintain total inventory investment at the desired level simply by manipulating the planned maximum and minimum values. So, queue system, under queue system, the company places the order at a defined quantity, right. There are certain demerits also. What are the demerits? The orders are raised at irregular intervals, which may not be convenient for the suppliers because the production pace, it varies. Like when the demand is high, right, particularly in seasonal industry, when the demand is high, usually the material requisition is fast, more frequent. But in other seasons where the demand is low, there the procurement, there may be the gap between two procurements may be bigger. So, it may not be convenient for the suppliers because suppliers also need to plan accordingly. In case the lead time is very high, supply of inventory may interpret, right. Like for example, it can get hampered. EOQ may give you an order quantity which is much below the supplier minimum, and there is always a chance that the ordering level for an item has been reached but not noticed, in which case the stock out may occur. And the items cannot be grouped and ordered at a time since the reorder points occur irregularly, because it is not linked with time, it is linked with the level of inventory. The queue system, it is linked with the level of inventory, but not the time period, right. It is not like every month there will be an order. Sometimes the new order may happen in 15 days, sometimes the new order may happen in couple of months. So, these are the demerits. To address this issue, there is another model which is called P model of EOQ, where the order happens at a particular time interval, right. So, in this model, the stock position of each item of material is regularly reviewed, and under this model, the inventory is ordered based on fixed period. So, graphically we can show it like this, like graphical representation. So, you see this number of days are shown here, and these are the unit of stock. So, you see at every regular interval, this is the interval, say 15 days, right, from here to here, right, every regular period, right, new order is being placed irrespective of the level of stock at that point of time, right. Even if there is a stock, still the new order goes, right. So, this model is called the P model. Okay. There are merits in the P model. The ordering and inventory costs are low. The supplier will also offer attractive discount on sales are granted, and the system works well for material which exhibit an irregular or seasonal use and whose purchase must be planned in advance on the basis of the sales estimates. What are the demerits? It compels periodic review of all items. This in itself make the system somewhat inefficient because of difference in uses. The rate supply may not have to order until succeeding review. Equally important, the system demand the establishment of rather inflexibility order quantities in the interest of the administrative efficiency, and the periodic review system tends to pick the purchasing work around the review dates. So, these are the demerits of P model. How we can calculate the total cost? That is UQ by 2 into H plus D by UQ into O. So, this is the D is the total, UQ is the unit of the total number of unit which the company is ordering. So, when you are dividing it by 2, you are getting average order quantity, right, into the holding period, because that quantity you are holding, right. So, carrying cost plus, right, the annual demand divided by UQ, this many number of orders you are going to place into the ordering cost. So, this is the total cost. Fine. Okay. Now, so we answered the first question. The first question is what? The first question is that when to order and how much to order, right? When to order, when it will the stock level will come to the reorder level, and at no point of time it should be below the minimum level and beyond the maximum level. So, depending upon the reorder level, the minimum level and the maximum level, company will place the order. How much units it will place the order? The UQ, right. Now, once this order has been placed and the stock arrived in the store, then we need to calculate the cost of material, right. So, how to prepare the material cost, how to calculate the material cost. So, there are three methods which we will discuss. The first one is the first in first out or the FIFO method. The second one is last in first out or the LIFO method, and third one is the average costing method. So, first in first out method or FIFO, right. What does it mean? It assumes that the inventory which is coming first, it is also been issued first, right. The inventory which first arrives in store is also been issued first. So, that is the assumption. So, it is an inventory costing method which assumes that the first items placed in inventory are first consumed, and so what will happen? What will happen is that in such a case, at the end of the year when the inventory valuation will happen, it is assumed that it consists of the goods most recently placed in inventory. So, older items are going first, the recent items are staying in inventory. So, that is the assumption under this method. What are the advantages? It is simple to understand and easy to operate. Material cost charged to production represents actual cost. In the case of falling prices, the use of this method gives better results. Closing stock of material will be represented very closely at current market price. It is a logical method because materials are issued in order of purchases. So, materials received first are utilized first. So, it is logical, more logical, right. And also because the stock in inventory, right, we are assuming that is the recent one. So, it will be the valuation of the stock will be more close to the current market price rather than the past prices, right. And if the price is already falling, then your inventory cost will inventory value will also keep on falling because it is more recent. This method is useful when transactions are not too many and prices of material are fairly steady. What are the disadvantages? If the prices fluctuate frequently, this method may lead to clerical error. In case of fluctuations in prices of materials, comparison between one job and the other job becomes difficult. For pricing rise, the issue price does not reflect the market price as materials are issued from the earliest consignments. So, in FIFO, what we are assuming? We are assuming that the material which came first, it also went out first, right? And in stock, what remains? The most recent arrivals, right? Now, how to value this? Now, here is one question which we will discuss. You see on the left hand side, the first column are the dates, right? And on 1st June 2011, there is an inventory of 800 units and the price is rupees 6 per unit. Then on 5th June, new purchase happened of 200 units, that is 7 units, right? On 8th June, another purchase happened, right? That is 200 units at the rate of 8 per unit. Now, on 10th June, the first issuance happened, right? 700 units to work in progress. And 11th June, another issuance happened, 300 units to work in progress. Now, under FIFO, if we follow first in, first out, right, in this case, if we follow first in, first out in this case, then what we will assume is that this 700 is going out from here, first in, first out, right? Then this 300, first 200 is going from here, right? And another 100 is going out from here, another 100, right? So, how much will remain in inventory? You see, 800 was already there. So, 800 plus 200 plus 200, it is 1200, right? Out of 1200, 700, so this total, right, 800 plus 200 plus 200, so it is 1200, right? And you are issuing how much? 700 plus 300, 1000, right? Your issue. So, how much should be in store, right? In store should be 1200 minus 1200. So, this should be in your store, right? And in store, what should be the value of it? Because this has already gone out, this has gone out. So, what is left is at the rate of 8 per unit. So, 200 into 8 is equal to 1600. This should be the value of the closing stock, right? So, that is the idea. Now, the same thing we can show here. So, in 1st June, you see the opening balance is this 800 into 6, 4800, right? This is the balance. Then what happened? New purchase. So, it added, right? And amount has become, so now new purchase added. So, new amount balance value is 6200. So, 8000 plus 200 is 1000 here, right? Then again 8th June new purchase. So, both of them are purchases, right? Now, again the rate changed at 8. See, the rate is continuously changing. So, now the value is how much? 1200, the value is this, right? So, 6200 plus 1600, 6200 plus 1600, 7800. Now, the issue, first issue is happening. So, first issue, because we are following FIFO, we are following first in, first out. So, from where it will go out? From here, right. So, we will value it at 6, right? If we do it, the 700 into 6 is 4,200. So, how much remains? 500, right? Then again 11th June, further issues happened, right? So, here you see 100, the remain 100 will go from so 100 at 6 rupees per unit, right? And 200 as at 7 rupees. Sorry, it will not be 8, 6, it will be, yeah, I repeat. Now you see, out of 800, the 700 has been gone, right? So, how much is left here? 100, 800 minus 100, that is 700, that is 100. So, 100 into 6, and this 200 is going from here. So, it is 2000, and what is left? It is 1600 again. So, here you see what we calculated here. Here also we calculated the balance value should be 1600. In balance. So, so this is the closing balance under the other method which we will discuss now. It is called last in first out. So, in last in first out, it is an inventory costing method which assumes that the last items placed in inventory are first consumed during an accounting year. And so, what we are assuming here, that what came last, right? That goes out to production fast, and the which came earlier, right, in the past, that remains in the stocks, right. So, in that case, the value of inventory, it will reflect what? It will reflect the older prices, right, the older prices at which the material is been procured. Now, what are the advantages? The cost of material issued will be nearer to the current market price. It enables us to match the cost of production with current sales values. The use of method during the period of rising prices does not reflect undue high profit in the income statement. In the case of falling prices, profit tends to rise due to lower material cost. In the period of inflation, LIFO will tend to show the correct profit and thus avoid paying undue taxes to some extent. What are the disadvantages? Calculation under LIFO system becomes complicated when frequent purchases are made at highly fluctuating rates. Costs of different similar batches of production carried on at the same time may differ. This method of valuation of material is not acceptable to income tax authorities, because income tax now they do not allow, right, LIFO. The stock in hand is valued at price which does not reflect the current market price. This is one of the biggest disadvantage of it, that it is further to the current prices, right, and and if it is fluctuating continuously, then it becomes very difficult. Closing stock will be understated or overstated in the balance sheet. Okay. Now, let us see one practice question. Now, you see in this question, the same similar problem. First purchase happened at 1st June, 100 units, that is rupees 5 per unit, and then again next purchase happened at 500 units, the rate changed here, right. Then issues happened on 6th June, and again new purchase at rupees 10, then 300 units, work in progress. So, here you see what will happen, because it is last in first out, right. When this 200 will be issued, right, it will be assumed that it is issued from here, the latest purchase, right. Similarly, when this 300 units will be issued, it will be assumed that 100 units are issued from here, and rest 200 units are issued from here. Rest 200 units are issued from here. So, this 100 units, it remains in the stock. It will be assumed that it remains in stock. So, this is the difference between the FIFO and LIFO. Okay. Now, let us see the solution. So, you see first 1st June purchase 100 units at 5 per unit, 500, balance unit is 100, amount 500. 5th June purchases 500 at 8 per rupees, amount is 400, units 600, 4500. Then what happened? Then it is issued, right? Now, this issue, you see, this issue is at this rate, because it is assumed that this 200 units, this is issued from here, not from here. Fine. So, 800 and into 2, 1600, and of course, 4500 minus 1600 is 2900. Then again purchase happened, right, and 100 into 10, now the rate got changed. So, it is 10 rupees. So, 500, 3900. Then issuance happened. Now, in this issue under the LIFO, what is the latest purchase? This one. So, this 100 is coming from here, right, and this rate is 10, right, and rest 200, right, because total purchase is 300, rest 200 is coming from here at the rate of 8. You see, here the rate is 8, here the rate is 8, and then we calculated this value, and this is the balance. So, this is the difference between FIFO and LIFO. There is another method which is called weighted average method, in which the material is issued at average cost, is called weighted average method. Now, you see this problem, right? This is a practice question, same question like the previous one. So, you see first purchase happened 100, 5, 500, units 100, this is the balance, right. Then again purchase happened 500, rate got changed 4600, 4500. Now, it is issued, right, it is issued. When it is issued, you see 200 units, we have taken what? We have taken the weighted average of the two, right. So, if you calculate the weighted average of the two, you will get the 7.5, right. So, 100 into 5 plus 500 into 8 divided by number of units, if you do, you will get this value. The weighted average is 7.5. So, 7.5 into 200 is 1500, and this is the balance amount. Again purchased happens 100, 10 per unit, 1000, so 4000, and at the time of issue again what happened? We took the average, right. So, if you take this 100 has already gone, so what is left is 8, so it is 8. So, 2400 and 1600 is the closing balance. So, thank you. So, at the end I am again making a recap, right. So, material, the valuation of material, we are concerned with primarily with two questions. The first question is when to order, right, because material in particularly in manufacturing concerns, right, it consists of a major cost, right, it involves a large chunk of the total cost of a product. So, there the material cost control and management, it is very important and significant. So, while managing this, primarily we deal with two questions, right. First question is that when to order, when to make the fresh orders for raw material, and second question is how much we should order at one go, right. And once the stock arrives, then there is another issue which is linked to the valuation of the stock. So, in today's in this module, we covered all these three areas. In the first area, we have shown that how the company can calculate the reorder level, the minimum level and the maximum level of stock, right. It depends upon the lead time, right, the consumption, and the consumption at the factory of the raw material or particular raw material. And in the second question, we covered the concept of EOQ or the economic order quantity. Economic order quantity is the quantity which the company should order, right, at a time, right. Now, we need to decide this quantity based on two costs. Basically, we need to optimize the total cost. So, total cost is equal to the carrying cost. What is carrying cost? Carrying cost is the cost the company is incurring for holding that particular stock, right, and ordering cost, right. That is, for each time they are ordering, there are some processing cost, administrative cost, etc., etc. So, these costs. Now, they go in opposite direction. If the number of orders are more frequent, right, then the total ordering cost will rise, right. But at the same time, the carrying cost will fall because you are holding less amount of stock at a time. And vice versa is also true. If the number of orders are less, your total ordering cost will come down, but at the same time, the holding cost, the carrying cost will go up. Fine. So, we need to make a balance between two types of cost and we need to optimize this, right. So, EOQ is one of the answer for that. So, we have shown with an example that how the EOQ can be calculated, right. So, there are two models, one is Q model, another one is P model. Under Q model, a fixed quantity is been replenished when the stock level reaches the reorder level, right. So, the time lag, the time difference between two orders, they may be unequal, they may not be even, right. There is another model which is called a P model, where the company orders at a regular interval irrespective of the existing stock in the inventory. Both the models have their own advantages and disadvantages, which we discussed. Now, once this is happening, the new stock is coming and it is going for the production, right. We need to value the inventory stock. Now, we discussed three methods for valuing the inventory. First one is called first in, first out, or FIFO. Under FIFO, we assume that what came first, right, that goes out first, right. That means the latest arrival is staying in the stock and the older stocks are going out, right. So, there are certain advantages of this method. The most important advantage is that your stock will be more in sync with the current market price, right. So, this is FIFO, and the other method, which is called LIFO, last in first out, it assumes that the last one, the latest arrival in the stock, it goes out first, right. In such a case, what happens, the older stock remains in the store, right. LIFO is not very popular and it is not allowed by the income tax authorities. One of the fundamental reason for it is that the stock valuation doesn't reflect the current market price, right. Particularly in an economy where the inflation is happening, right. So, the stock value may give you an unrealistic picture, right. So, it is not allowed. And third method, there is a balance, to balance both of them. There is third method, which is called average cost method. In average cost method, we take the average value, right. So, there is one higher value, there is one lower value. So, we take the average. So, we have shown illustration for all the three cases. Thank you. Thank you very much.